All right, all right, all right. How's everybody doing? It's good to see everybody this fine morning with the market flushing like a toilet. All right. Hope everybody's portfolios are doing well, and you got yourself all protected, like we talked about, right? You got all your put options in there. You got your YQQQ. You're done all the things to protect yourself against the downside. You just plain got out if you needed to, right? Needed to just do that with some of your funds or some of your markets. So we're doing good today. My portfolios looks like it's up about $7,000, so that's not bad. And we're ready to get started here, rocking and rolling. Now I want to talk to you about something. And I have this little marquee, right, that we put out, the little thumbnail. And I always like to pull that up here just to kind of get us on track and let people know what we're talking about today. Um, Yield first investing. Now, I want to talk about this a little bit today because that's what our primary focus is here at this channel, right? That's what we do. We learn about how to make money in the stock market today, not tomorrow. Not for tomorrow, but for today. And so we're taking money out of the market, so we're making an income out of it. Now, if you don't need the income, you shouldn't take the money out. I mean, frankly, right? I mean, the reason you take it out is because you need it for income. But if you don't need it for income, you probably shouldn't take it out because then you have to pay taxes on it. So, unless you're in a Roth and you're taking money out of a Roth, that's okay. But even if you're taking money out and you're spending it out of your traditional IRA, you have to pay taxes on it. So if you don't need it, don't take it out. Now, if you're in a traditional IRA and you're doing this yield first investing type stuff that we do here, you can buy and sell and get your dividends and do all that neat stuff. Just don't take it out and spend it. But you can do all the manipulation, management, and there's no tax penalty for that. So that's what's really cool about being able to trade in those in like a traditional IRA or in a Roth IRA. It's because you can manage your portfolio all you want, buy, sell, no tax problems, nothing. So you can manage a little bit easier over there without having a tax implication. But if you're out in just a a normal account, then anytime you sell your fund, if you have a loss, well, you get a tax loss harvest that. That's fine. That's great, right? But if you sell it and it's got a big profit, well, then you have to take that uh, as a distribution, or you have to take it as a realized gain, and you have to pay taxes on it. Well, when we do yield first investing, every time you get a dividend, if you're out in that normal market, right? If you're in a traditional market that you have to pay taxes on, every time you take a dividend, well, that's like taking a profit out of your account. So every time you take a dividend, you have to pay taxes on it. All right, it's not like just selling your shares. Obviously, if you have the profit, you're going to have to pay taxes on whatever you sell, even if you're going to turn around and put it right back in. Well, it's the same with a dividend. If you take a dividend and it comes out as a dividend, and then you just turn around and put it right back in, then you're going to have to pay taxes on that every time you get the dividend, and then you're just going to reinvest it. So maybe it would be better not to take it out in the first place, right? We've talked about this at great length. And the reason I want to talk about this is because I've taught this method to a whole bunch of people, dozens and dozens of people down at the university. I've had lots of students come through my course material in the last year. I've been teaching this for about a year and a half. That's about all I've been teaching it because that's all I've been trading it. It's brand new, right? We haven't been able to do this type of trading for a very long, forever. I mean, until just the last couple of years, if they've even been available. So I started teaching this about a year ago, and I've had, 2 semesters, 2.5, I guess. Yeah, it was about 2.5 semesters. The first semester, I didn't really teach it hard because it was so new. I only kind of picked it up and kind of showed people what's starting to come. So it's been about 2 semesters that I've been able to teach this at the university. Now, remember, I don't teach the young kids. I don't teach young kids. I don't teach the young adults. I don't teach the college age kids, what we consider college age kids. I teach the continuing education courses. So I teach adults. I teach people who have money, who have retirement accounts, who need to use this money for income. And I've had a number of people come through the course and through the class, and some of my old students come back and want to learn how to do some of this stuff. And I just had the reason I put this up here. Can't teach old dog new tricks, because I had a couple of old students who were trying this on their own. All right, I kind of taught it to them, showed them the course material and stuff, and showed them what I was doing a little bit. And then they thought this was the greatest thing ever. And they jumped in with both feet, put a bunch of money into it, and just thought that, they'd buy, hold this thing, they'd be rich, rich, rich beyond their wildest dreams. And suddenly the market started to go down, and they realized that they could lose money in the stock market when the stock market goes down, even in the high yield funds. And they're like, oh no, I'm losing money. Your system sucks. I can't believe this. How come you got me doing this? Don't blame me that the market goes down. I can't make the market go up. I tell you all the time, this is my power. This is how I make the market go up. I'd stab this little guy right here, make the market go up, go up, go up, go up. That's how I make the market go up. I don't have any power to make the market go up. Market goes down, then you have to be smart enough to adjust and to pivot and to protect yourself. I made my portfolio. I'm very transparent about my portfolio, right? I came in and I put $250,000 into YQQQ. Now, what's YQQQ? It's a market that makes money when the stock market goes down. But has the stock market been going down for the last year? No, it's been going straight up. So this market was going down. Well, that makes sense, right? I mean, if the market's going to flush down like a toilet, and you look at a market that has been losing money during one of the biggest up bull trends in all time, that market's going to be looking like it loses money, right? Makes sense. It's the opposing side of the winning trade. So now where the big market's gone up so high, right, and it starts to get really, really in the overbought region, and way back up there in the what we consider to be the, let me pull up my little chart here. When we go way up into the delta cone of probability of this thing getting way up into the second, third, it even went up into the fourth standard deviation. And so by the time it goes up into the fourth standard deviation, I mean, the probabilities of that thing going up anymore is so low that I had almost no risk to put a huge percentage of my portfolio into a short position, because the upside on it was almost nothing. I mean, almost inconsistently low. I mean, it's 99.7% of the time it falls back to the one standard deviation from the third standard deviation, and we were up into what looked like to me the fourth standard deviation. So I had, almost no risk by putting a quarter. So I sold off so much of my portfolio, got out of it, and put it into the short side of the market. And I told you guys that. You all knew that. So that should have been a signal to you. Hey, Land thinks the market's going to go down. Now, do I know? I don't know. I have no idea what the market's going to do. Don't blame me. I hate these texts where I get blamed for people losing money. It's not my fault. I don't make the markets go up and down. All I can do is teach you, show you what I do. And I've been saying for, I don't know, 2 months now that I was worried the markets were going to flush out. I might have been a little early, right? They didn't flush out quite where I thought they would. I thought they might flush out 2 weeks ago, 3 weeks ago. But no, they waited an extra week or two. That's okay. I've got perfect timing. But, this market, we always talk about the markets following the Wyckoff theory. I mean, how many times have I pulled this picture up for you? And so, here's my picture. How many times have I told you this is where the market was in our map? Oh, well, Land, that map was drawn 50 years ago, and this is 2025. That map's not going to be anything. You can't follow that map in 2025 if it was drawn 50 years ago. You want to bet? You want to bet? Here's Apple. Here's Microsoft. I mean, how many times do I have to show you guys that the computers, the big banks and hedge funds, they haven't changed the way they trade in 50 years. Why not? Because they buy low and they sell high. That's what they do. And you think that I'm teaching you something new. I'm not teaching you anything new. I'm just saying, look, markets buy low and they sell high. That's what they do. And the big, huge guys that own all the money in the world, how many times have you heard me say that? The big banks, hedge funds, BlackRock, Vanguard, State Street, they buy low and they sell high. And so when they're done selling, there's no more buying. And so you and I can't move the markets. We're like a pimple on the ass of an elephant. The market's so big, you and me, we're not even a pimple on the ass of the elephant. We're the hair that sticks out of the pimple on the ass of the elephant. That's how small we are. We can't move the markets. Yeah, who do you think moves these markets? It's the big, huge guys, the guys that have all the money in the world. And the only money they don't have is yours. And the way they take your money is that they buy low and they sell high. And and I've showed you, and I've talked about this ad nauseum, and the reason I'm going off on this is because I just had two students drop out because they lost money. Like, of course you lost money. The market was going to go down. I've been telling you that yeah, but I didn't know the market was going to go down. Well, let me see. When was the last time you came to my class on YouTube? Oh, you don't go to my class on YouTube. Oh, no wonders you didn't know. Well, when was the last time you read your Pit News magazine where I teach you all these strategies? I know you have it because there's your subscription service to it right there. Now I blanked out this guy's name, but here's Pit News magazine. Did you open it? Now I can't tell if you read it. I can tell if you opened it. I can tell if you opened the email, and I can tell if you clicked on the link. Now, I don't know if you went over and read it. If you clicked on the link, you might click on the link and then not read it, or you might click on the link and read every single article. I don't know that, but my system does tell me when I send you an email whether you're getting your emails and whether you're opening them. So I can, that's just the way internet marketing works. I can tell the emails that I send out of people. It sends me a read receipt. It says, yeah, that guy, and then you clicked on the link. So look at this, Pit News magazine. Did he open it? No. Did he read it? No. Did he open it? No. Did he read it? No. Did he open it? No. Did he read it? No. Did he open it? No. Did he read it? No. How long have I been sending out all the updates, all the information, all the good stuff that I teach at Pit News magazine? I teach in all these classes and courses and stuff. I spend a whole month, literally hours and hours and hours and hours writing Pit News magazine, working on Pit News magazine, helping people learn through Pit News magazine. And then nobody reads it. If you're not reading it, why in the hell am I even doing it? I'm making money over here. I made $400,000 last year. Let's just do a little math here. And this is free for you. I don't even charge you to come and watch the YouTube channel. I teach you all this stuff for free. Now I charge $39 for a year of Pit News magazine. You know why I charge $39? So that I can find out if you're paying any attention. Because if you're not paying any attention to the stuff that I'm trying to teach you, I ain't helping you. I ain't going to help you. You call me on the phone and I say, oh, you don't even read the magazine. All the work that I put into teaching you this stuff. And then you call me on the phone and say, how come I'm losing money in my market? Well, did you read article number 2 in Pit News magazine last month? And I told you how to hedge your position because I thought the market was going to fall. I'm just cussing everybody out who's losing money in these markets because you didn't listen to me. And maybe you listened to me and you didn't do it. Maybe you didn't act. I don't know. Maybe you didn't know how to act. I told you, I tell you, I help you. Let's do a little math. I'm just going to do a little math for fun. And I'm kind of pissed off, you can tell. All right, here's a calculator. Land Turner, and this wasn't even in my businesses. This was not it. This was just my stock investing. All right. I have businesses, I have real estate, I have all kinds of ways to make money. I have multiple sources of income. But let's take $400,000 because that's what I made in my trading accounts last year. 400,000 divided by 2,050. That's how many hours you work in a year, right? 2,050 hours equals. I make $195 an hour. $195 an hour. That's what I make. That's what I made in my stock trading last year. If you take that, $195 an hour. How many of you guys make $195 an hour at your job? How many of you made $195 an hour? Now, I'm sure there's people who have. And there's people who make more than that. But that's my time. $195 an hour. And you can call me and set up an appointment on my calendar at landturner.com and talk to me for free. So if I talk to you for half an hour, or if I talk to you for an hour, I help you with your software, that's what my time's worth, $195 an hour if I work at a labor job, right? Trading my time for money. And that's what I do. I trade my time for money here. I mean, I'm not trading my time for money that you give me. I give you my time for free. Don't blame me. Not my fault you lost money. I've done, what else? What more can I do? I mean, I've given you, I write all this stuff down at Pit News Magazine. That's what Pit News Magazine is. It's chock full of all the stuff we talk about and teach in these classes. I have my whole course that goes out with all the articles that we've written in Pit News Magazine for the last 2 years, all saved in this one place. Most of you have it. I create all these little calculators for you that we use here in class, right? I mean, I come in here and I spend, how long do you think it takes me to write all these little calculators, right? And they're just free. I give them to you when you come to class. And they tell you all this great information. They tell you how to calculate your profits at break-even points. We talk ad nauseum about how these funds work with break-even points, right? You can go back and see all this stuff, how we use all these calculators, all your dividend calculators, how we compare them against others. I got another calculator. I just spent a week writing this new calculator right here, this one. This is our cross-asset hedging calculator. I'm going to teach you that one. Probably teach you that one. If I don't teach it to you today, I'll teach it to you next week. Right? We're getting ready to use this new calculator. What's this for? Well, it's to help you hedge if you need to hedge. We've been talking about different ways of hedging. I got another calculator in here. This is the Pitt News SPY calculator. We're going to talk about that one sometime too. That's not part of today's lesson. This is just a way of the S&P 500 is broke down into sectors, and so we can sector rotate. So that's another great little calculator I created. All right, so we can do sector rotation. We've created a portfolio matrix. I mean, we've spent not thousands of dollars. We spent $100,000 or more. My son and I both working on portfolio matrix. So you guys have this a calculator to help you understand, because the traditional brokerage firm doesn't show you the proper way to calculate these high yield investments, because we take the market and we turn it on its head, right? Everybody's so worried about growth. Growth is the big thing. Oh, I bought it low and I sold it high. We talk about that ad nauseum, right? That's how we trade: buy low, sell high. That's what we talk about here. Microsoft, they went through the accumulation stage down here, right? Just like the little math formula that we just showed you, the little map. So there's your map. So there's the accumulation stage right there. And that's what Microsoft went through. Then it went through the big rally, just like that. It went up and created this little double top up in here. Now it was a little wider than I thought it was going to be, but it did. Went up, created the little double top, just like that. And then it's flushing down the back side, just like that. I mean, I can't draw it any clearer for you. Can't draw it any clearer for you. How do I draw? Oh, that's only in Microsoft. That's the only stock that did that. And you're showing us that just because you're cherry picking. You want to bet? This is Apple. Look at Apple. Did the same damn thing. Went through the accumulation stage right here. Went up through this big stage right here. Give us this little double top up in here. And this might be another double top. I don't know. But this thing came all the way back down, just like we talked about right here. Go through another accumulation stage. Now, this accumulation stage was small, but starting to go back up. This is the delta Kona probability that we talk about ad nauseum on this channel, right? Let's go look at another one. Look at Amazon. Amazon. Pull it up. Pull it up. Where is it? Where's your little picture? Come on. All my little pictures keep falling away. There they are. So look at the little picture. Look at Amazon. Man alive, that thing had bad earnings. So look at it, but it went through the accumulation stage down here. It went up through the stage. It went up in here. Now it's flushing back down. If you're short Apple right now, I mean, Amazon, if you're losing money on Apple, it's your own fault. I told you it was going to flush. I told you. I told you Apple was going to flush. Now Apple went down and now it went back up. Look at Microsoft. Microsoft's another one. There's Meta. I told you these things were going to flush. And if you didn't protect yourself, not my fault. Don't blame me. Don't call me. Don't send me texts in the middle of the night saying I'm dumping out of these funds because they suck. Why are you blaming me? You didn't go and read Pitt News Magazine. You didn't come to my lessons. You didn't protect yourself. You didn't do anything I did. I mean, I did it, and I told you everything I was doing. I tell you everything I'm doing. I don't sometimes tell you when I'm doing it, because I do it not when I'm on TV, right? So I come back and I tell you, I show you my spreadsheets. I give you my spreadsheets. Did you go and put all your stuff into your spreadsheet? Do you have it in the spreadsheet? No. Why not? It's hard. Being rich is hard. Being poor is hard. Pick your hard. Which hard do you want? You want to be hard? You want to be poor? That's hard. You want to be rich? Yeah, it's hard. I'm not going to be rich or hard. I'll just be middle class. Okay, we'll do that then. Don't blame me. I'm tired of these emails of people writing. It makes me not want to come and do this anymore. I don't care. Why do I care? I'm making $400,000 last year in the stock. Why do I care? Why do I give a shit? I'm almost 65 years old. I'm not doing this very much longer. I try to help people. Try to show you what I learned at the Chicago Board of Trade. I worked there for 10 years. Come and share my knowledge with you. It's for free because you're not paying $2,000 for it in some course that some guy sold you on YouTube. It's not worth anything. That's the problem. If I'd made you pay me $2,000 to be here, you'd be paying attention, man. You'd be doing your spreadsheets. You'd be reading every magazine I sent you because you spent $2,000. But because I do it for free, it's like, oh, you rich people, how come you don't just show us for free if you're so rich? Why do you charge us? Well, we charge you because you won't pay attention if we don't charge you. Because they give it to you for free. It's not worth anything. My Pit News magazine, $39. That's all I charge. And it's got all my information, everything I can share with you. I give it to you for $39 a year, and people won't pay for it. And if they do pay for it, they won't read it. And then you blame me that you're not rich? Don't blame me. Don't blame me. I'm doing what I said that a rich person should do. They should give their information away for free. How do you do that? How did you get rich, Lan? I'm telling you. I'm showing you. I'm teaching you, and I ain't charging you. Well, it's hard. Being poor is hard too. Go be poor. You're not going to do what I show you. I can't make you be, I can't do it for you. I can't do it for you. Look at Microsoft. Look at NVIDIA. What do you think? NVIDIA is pretty strong. It's staying up there. There's another model where it goes up and stays up there and then goes up again. That's called the reaccumulation stage. NVIDIA is not falling. It's not falling down yet. Doesn't mean it can't. Certainly can. I don't know what it's going to do. What's the probabilities? Well, if we go from the accumulation stage of last time up to the top, well, all I know is the probabilities say the market's probably going to come down into this region. Does it have to? No. It's just the probabilities. Oh, I don't know what probabilities are. Well, go learn. There's lots of YouTube channels that teach you what probabilities are. You don't have to go to college to get a college education anymore. You can learn everything that there is. Elon Musk tells everybody, don't go to college. All they're going to do is teach you how to be woke. He says, go learn on your own. You can learn anything there is out there on your own. You don't need to have a college education if you're self-driven. The reason people go to college is because they're not self-driven. They have to have a structured format for them, all laid out in front of them. I don't know. I'm going off on a rant and rave here because it makes me feel bad when I do everything I possibly can. I don't know what else to do to help people make money in these markets. I'm showing you the best thing that's ever happened to me, the best thing I've ever found. Made more money than I've ever made. I never made $400,000 in the stock market in 1 year before. That's more money than I've ever made. And I'm showing you how I did it. I took you through the journey. I got 2 years of YouTube channels out there. You can go watch it from the very beginning and watch how I started and how my journey and how I've learned and how I processed all this stuff. You go watch all my videos, you'd learn the whole process. Well, I wasn't here 2 years ago, Lan. It's on. You can go. I've saved all the, if you subscribe to Pit News Magazine, you get all the articles. I'll give you the course for free. You get the course for free on all the things we've done with all the articles that were written about this subject for the last 2 years. And you also get, you go buy my book. My book's $39. No, it's like $49. Amazon raised it from $39 to $49. It's $49, but you can get the digital version on my website for $19. I do sell the book. But you can get an Amazon, a print version for $49. I don't make anything money on that. Amazon makes all that money. It's like 200 pages, full color, 8.5 by 11. It's a big, beautiful book. It's $49. It costs a lot of money to print a full color book. Oh, you're getting rich selling your book. No, I promise. I'm just trying to help people. I teach at the community ed education. It's a continuing education. You know how much money they pay me to teach at the university? They pay me enough to maybe pay the gas to get back and forth to school and back. That's about how much I get paid to teach at the university. I don't even know if it covers the gas cost. Certainly doesn't cover the cost of me to come down here and live. I mean, I live down here. Of course, I live down here anyway, but I have 2 houses. I live up north and I live down south, so I can go back and forth between the two. I chase the good weather, right? Call us snowbirds down here. So I'm a snowbird, so I'm down here anyway, but I mean, it's not like I'm getting rich coming down here to teach community education, continuing education. Look at this. This is Palantir. Palantir, nobody ever thought Palantir would fall. Palantir's, it's the greatest stock I know. It's never going to come back down to the cone of probability. What do you mean it's never going to come back down to the cone of probability? It's right there right now. I told you it was going to come down there. And if you lost money in Palantir, it's not my fault. I told you. How many times did I draw this picture? How many times? How many times did I draw this picture for you? Accumulation, expansion, distribution, consolidation. What? I mean, I don't know how to make it any clearer. That's what markets do. Do all markets do that, Lan? No. But mostly the big ones that are traded by the big funds do. The ones that are traded by the big hedge funds. Why? Because they trade with computers. They don't sit there and click their little mouse buttons and make the trading decisions. It's all pre-programmed. It's all pre-programmed. That's why it's so predictable. Because it's pre-programmed. It was programmed 50 years ago into their old computer systems. And they've just been rolling them forward ever since. Why? Because it works. Makes them money. Because retail traders are stupid. Retail traders buy high and sell higher, sell low. Retail traders try to buy high and sell higher, but the markets don't go higher, so they can't. It's really hard to buy high and sell higher, especially when markets don't want to go higher. I wish I have the upside down pyramid slide, and I can't find it. I got to go find it because I keep wanting to show that to you. I thought I had it, but it's where one pyramid is upside right. You've heard me talk about this ad nauseum. One pyramid's upside down. The one that's upside right has a nice strong foundation, and it goes up to the peak. That's what big commercial hedge funds do. They buy through the accumulation zone, and then they sell all the way up to the top till they get to the top. There's nothing left. They haven't got any money left. So they pull their support out. That's what causes the market to fall. Well, retail traders, they do just the opposite. They start off with one share, and as the market goes higher and higher, they buy more, buy more, buy more, buy more, buy more, buy more, buy more. So they end up with a dollar cost average with an upside down pyramid, with all of their holdings at the very top of the pyramid. So all the market has to do is just fall this far, because their dollar cost average pulled their average price up. Market falls that far, they lost everything. They lost it all. It's all gone. Because they didn't do the accumulation distribution model. They didn't accumulate at the bottom and sell out all the way at the top. Well, you don't have to do that. You can act like a hedge fund. Why do you think they call them hedge funds? Because they don't want to get out of their position, because they're going to have to pay taxes on it, right? So what do? They hedge their position. They protect themselves to the downside. And that's what this little calculator is all about that I just created for you right here. All right. So we talked about pairs trading. Remember pairs trading? Some of you have been here. You know what pairs trading is. Where's my little calculator? Here it is. So you come over here. I talked to you about this little portfolio, this little calculator I just created right here. So this little calculator, it's even got a strategy guide. Look at that strategy guide. Come in here. It's going to teach you the whole concept right here. And even if you want, you can come in here, and it's also got an interactive lesson that I've put in here for you. Look at this little interactive. It's like a little slideshow that shows you with pictures. So you got pictures, how to do it. Okay, congratulations, certificate of achievement, right? Just like school, right? So what we're going to do with this little calculator is, because we're going to be using the yield max funds, right? So if we're in the yield max funds, we want to have yield, right? Yield first. That's what this whole class is all about. That's what this whole trading series, this whole channel, that's what I'm teaching at the university primarily now, is all this yield first stuff. And so you have growth, which is great. We all love growth, right? Buy low, sell high. That's the growth model. But if the market's going up, that means that you're not taking money out. Makes sense, right? Because if you're taking money out, it's not going to go up. Now, the market might go up, but your fund is not going to go up. Why? Because you're taking it out every month and spending it on a new Tesla, a car payment, some food, right? People have to live. We take money out of the stock market to live. Well, I don't, Land. I've never taken it out. Okay, well then don't come to this class, because this class is meant for people who want to take money out of the stock market and live off of it. If you're just trying to grow a great big golden goose, don't come here. I'm not teaching that. You're not going to learn that here, because that's too easy to learn. Have 30, 40 years of life and go put your money into one of the best stocks you can guess that's going to be big in 30, 40 years. And then go work for 40 years at the gas station. And every time you get a check, put it into that big stock. And in 40 years, you should have enough money that by the time you're tired, you shouldn't have to work at the gas station anymore. That's not what I want to do. I don't want to do that. I want to not work at the gas station today. And I want to take money out of the stock market to live on. And if I'm going to take money out of the stock market to live on, well, that money is not going to be there to grow a big golden goose. At the end of my lifetime, I'm not going to have a great big huge gold egg. Why? Because I took a whole bunch of little tiny gold eggs out all along the way. So at the end, there's nothing left. If that sounds good to you, well, come and hang out with me and I'll show you how I do it. But if you want that big gold egg at the end of the year, at the end of your life, don't come here. I ain't teaching that. That's lots of guys over there can teach you that. Just go put your money in the S&P 500. Go put it in the QQQs. They've already diversified your portfolio for you. They've done all the hard work for you. Just go put it in the QQQ. They'll manage it. They'll move it around. They'll change it. They'll take stuff out of the Qs. They'll put it back in. They do all the work for you. You don't have to do anything. Just go put it in the Qs. And go back and work at the gas station for 40 years. And at the end of your life, put all your money into the Qs all along the way, everything you got. And then at the end of your life, you'll have a big egg, great big egg. And you didn't have to do anything. There you go. Buy and hold. That's what that strategy is. Again, I don't want to do that. Doesn't mean I don't have some of that. Sure, we all have a little buy and hold. That's a wise choice to have some of that. But my focus, what I'm teaching here, what I like to do is I like to take a little bit of gold out every month. Because who knows, at the end of the life cycle of 40 years, maybe the market flushed, went down. My great big golden egg turned into a little tiny golden egg. So all I had at the end of life was a little tiny golden egg anyway. So I've been taking little golden eggs out every time I make some money along the way. And so to do that, we've got new tools that have been given to us and made available to us. And one of the companies that provides those for us is called YieldMax, right? And you can find it on the internet. It's called YieldMax ETFs. There it is. Look, YieldMax ETFs. I'm just telling you what I do. I'm not telling you what to do. Just telling you what I do. This is the company I like. Are there others? Yeah, there's others. I like this one the best. Second best is one called Granite Shares, right? GRAN. And I like this guy's too, but I don't like them as much as I like YieldMax. And there's reasons why. And I'm not going to get into all the reasons why, but these guys have ETFs here too. And the ones that I like on them are called the Yield Boost. All right. They have lots of them. I don't like all of them. I just like these. And they're getting more and more and more and more of them. They used to only have 4. Now look how many Yield Boosts they have. They're trying to compete with YieldMax. So you got YieldMax and Yield Boost. Now you'll notice when you go into some of these, they're all brand new. The little charts can only be like this long. So they're just all brand new, brand spanking new. Now YieldMax been around a little bit longer. So when you go over to YieldMax, some of their charts are 2 years long. So we have a little history on them. But their charts go straight down. Well, yeah, that's because they're taking the profits out. So they go down. If you take the money out and the stock market goes down, well, the funds are going to go down, but they're still kicking out yield. They're still kicking out money every month, right? Now, they're not they call them dividends because they have to, because that's what we call them in the stock market. But in reality, they're not dividends. They're distributions, right? So when you have a YieldMax fund that kicks out some money and sends it to you every week, they do it every week now. They used to do it every month, but they switched to every week because, we're all a bunch of Pavlovian dogs and we have to have our little treat every week now. So they give it to us every week. So every week, every Friday, we get our little Pavlovian feel, I'm not going to tell you what my instructor at the Chicago Board of Trade used to say. He's like, retail traders have to have an orgasm every single week. They have to be paid every week. He used to say that clear back in back at the board of trade. Retail traders have to be happy all the time. It's like this is the Pavlovian dog problem. That's why they pay you out your distributions every week now. They used to do them every month. They used to do them every quarter. Now they do them every week. And now you got some that pay them out every day because you got the 0 day till expiration ones. They pay them out every day. So, yeah, you get your little treat. We're like little puppies. We have to have a treat. So that's why they're the way they are. Anyway, going down a rabbit hole here. So these are your funds. All right. So if you go and look at these funds, they're pairs traded. Right now, many of them they do have diversified funds. And so the diversified funds, and they have different kinds of funds. They're not all the same, right? You can't put them all in the same basket and shake them up. They have different types of groups of funds, and some I like better and some I don't like at all. All right. So not everything in Yield Max is like, oh, Lamb loves everything in Yield Max. Whatever it is, if I just buy it, I'll be rich, rich, rich beyond my wildest dreams. It's not the way it works. You have to work these things. These things have to be worked. All right. You have to take care of them like a little puppy. You can't just buy them and hold them for 40 years and expect to get rich. And that's what these guys are doing. And so they're not reading their Pet News magazine. They're not keeping up with the new information that I come up with and that I publish. I publish in the Pet News magazine every month, along with a whole bunch of other people who are doing the same thing. And we all work together as a team. And we all write the articles that we're doing this stuff. It's a great magazine. If you don't have it, you're not willing to pay $39, don't expect me to help you. Because I ain't going to do it for, I do it for $39. That's just, to me, it's a signal. It just says, yeah, this guy's, he's serious enough about what he's doing that I'm willing to help. All right. That's all it is. $39 keeps the riffraff out. Because if you're not willing to pay $39 and if you're not willing to open up the magazine and read it, I ain't helping you. So when you text me and say, hey, what you looking at? I open up this. Well, I'm looking at the stock market. It's tough today, isn't it? Oh, it's going up today. Yeah, great. That's what you're going to get from me. I'm switching over to this thing. Oh, that sounds good. Go do that. Yeah, that sounds fun. Good idea. Oh, these Yield Max funds, they suck. Yeah. Oh, yeah, they do. They can. They could really suck. Yep, you're right. They suck. Why? Because you don't. Why would I help you if you're not willing to help yourself? I'm writing. I'm sending you books of shit to work on all the time to help you. You're not even reading it. Why would I do anything on the text? Why would I help you? Why would you call me on the phone? You're not willing to even do that. Why am I helping you? I got other people who do read every single issue, who open every single one. They listen to every single article. They call me on the phone and they know what I'm talking about. They know what I'm doing because they're here in class. They come to these classes and they read those articles and they're making money. And do we always make money? No, it's the stock market. Nobody makes money all the time. You just do the best you can and you make the best decisions that you can and you work on it and you protect yourself and realize that markets are going to go down. And when markets go down, everybody loses. Now, some of these Yield Max funds, when the market goes down, they lose money. They just don't lose as money as fast as if you were in the underlying stock. That's what this little calculator right here shows you. So we go into this little calculator here. We go into the break-even calculator, and this will show you that if the market goes down, let's say it goes down this far, and this is Airbnb. Let's go look at one that we're a little bit more familiar with. Let's do Apple. So if you come in here and you turn this down to 0, meaning that the market flushed, right, like a toilet, lost 50% of its value, went from 10,000 to 5,000. Well, these stocks that we're talking about, they still lose money. Look, they go down just like the rest of them. They just don't go down as far. Why? Because they're kicking out options dividends. And again, circle back around. The dividends that they get are not really dividends, they're distributions. What are the distributions of? They're distributions of options premium. So they're selling options, collecting the premium, and it goes into your account as income, and then they distribute that to you. You can take it, or you can put it back in if you want. You can reinvest. Now, a lot of people like to do that drip thing. I'm not real high on drip. I like to put it back in, yes, but not just right back into the same thing I just pulled it out of. And that's what drip does. So I'm dripping. I'm just not dripping directly. I'm not dripping it right into the same. I like to have it pull out when they give me my distributions every week, every Friday, right? Today's Friday. We're going to have a big payday today. And so if our stock's been drawing down this week, well, on Friday, we're going to get a big chunk of money from the options that we sold. So does that mean that we're not losing money? No, the whole market went down. So today, all of our stocks went down, right? But we're going to get a big chunk of money today, which will make us higher than the guys who didn't get distributions. Does that make sense? So it's not that you don't lose money. You can lose money in these markets. Of course you can lose money. The market's going down. It's flushing like a toilet. You're going to lose money. Oh, I can't do it. It's losing money. I'm going to put my money into something else. Well, is that something else going down too? Well, yeah, but it's not one of your yield max funds. It's the old traditional growth thing. Well, it's going down too. It's going down too. What makes you think that this is not a go down market? Markets go down. And if they go down, you lose money. Now, are there ways you can protect yourself? Yes, that's what this calculator is for. And what we're going to do here is I'm going to show you a really cool little trick. All right, I'm going to demonstrate it for you one time, and then we'll spend more time on it. We've kind of run out of time. I've complained for long enough. But let's go in and I want to show you. Let's use Palantir. It's a good example. All right. So Palantir has a pair, right? PLTR. This is the big, beautiful market that everybody loves, and it's following it's traded by the big hedge funds. How do you know? Because it's following the hedge fund strategy like a train on rails. Couldn't be any clearer. Couldn't be any. I could take a picture of that and put it in the manual and say this is an example of the cherry-picked stock that does this. But every single stock in the whole damn market's a cherry-picked stock today. They all did this. Almost all of them are on this train. Okay, so we're going to just pick Palantir because it's one of my favorite. I've made a lot of money on Palantir. Am I giving it back right now? No. I'm not losing any money on Palantir. Maybe a little bit, not much. I'll show you why. Because I know how to hedge myself, all right? And we talk about this. We're like, I've said it, but now I'm going to show it, all right? I've said it and said it and said it and said it. If you think the market's going to go down, you can protect yourself with a put option. That's what a put option is. Well, I don't know how to trade put options. Well, come to my class and I'll teach you. I've been teaching it on the YouTubes for 2, 3, 4, 5 years. Options is one of my favorite things. I've been teaching options as long as I've been trading, for years and years. I wrote the options software that we used at the Chicago Board of Trade. I wrote it. I wrote the software. Now, I didn't code it because I'm not a coder. I designed the software that we used at the Chicago Board of Trade. When I taught options at the Chicago Board of Trade, I taught it on my software. Other teachers used my software at the Chicago Board of Trade to teach options. That's how long I've been trading options. Okay. So I trade options and I love options. It's one of my favorite things. So when Yield Max came out and they said, hey, look, we trade options and this is how we make all this money. I said, oh, that's the neatest thing ever. They're doing exactly what I'm doing and they're going to do it for me. I'll just give them my money and let them do it because they're better traders than I am. And I'm pretty damn good. Okay. So they trade options for you, but you still got to manage their positions. I mean, they don't protect the downside. They're just trading the options for you. Now you have to protect the downside if you think the market's going to fall. Okay. Oh, my little wife's bringing me a tea. Thank you. Okay. So that's the name of the game. All right. So we're going to protect ourselves, and that's what this little calculator is for. So I want to show you. Let me get rid of this again. So I'm going to show you when the market gets up into these high dividend locations, or not dividend, into these high probability locations. So like we talked about on the delta cone of probability, right? When they get up in here, go over to the one more time. When they get way up into the here, right? So we got the 1 standard deviation, we got 2 standard deviations, we got 3 standard deviations. When a market gets up into that 3rd standard deviation, what we call the 3rd drive, right? Drive 1, drive 2, drive 3. You see me count them all the time. Doesn't mean it can't go to 4 drives, 5, 6, 7, 8, 9, 10. Certainly can. Doesn't mean it can't stop at 2. Does it all the time. Doesn't mean it can't fall. Go down through the lower standard deviations. Come back to the 1 standard deviation. Happens all the time. Doesn't mean it can't leave the 1 standard deviation, go down to the 3rd standard deviation, and only come back to the 2nd standard deviation, then fall down to the 4th standard deviation. Certainly can do that. It can do anything it wants. Market can do anything it wants. But the reason it does most of this stuff and the reason these probabilities are so high is because this is all programmed into these great big huge computers, and they trade that way to take your money. Okay. So again, that's why the markets are so predictable, because they've been programmed into the biggest computers, the biggest trading computers in the world to do this. So what we're going to do is when a market gets way up high like this and starts giving us these little double tops, we're going to protect ourselves to the downside. Does it mean the market's going to fall? No. And is our timing going to always be perfect? No. But at least we're going to have ourselves a little protection. We're going to buy some insurance. Like driving around. I got $100,000 in my account, and I'm driving around a $100,000 pickup truck with no insurance. That's what you're doing. If you don't buy insurance on your computer, on your trading portfolio, you're driving around a $100,000 truck, or however much money you got in there. Maybe you got a $500,000. You're driving around a $500,000 Maserati with no insurance. Who would do that? But yet we do it in the stock market all the time. Oh, because I'm just going to hold it for 40 years. It'll eventually come back. Maybe it won't. Maybe it won't eventually come back. I mean, all the doomsdayists are out there saying it ain't never coming back. This is as high as it's ever been, and it never coming back. They've been telling me that for 40 years, that it's as high as the stock market can go. Yes, it keeps going higher, but do you have another 40 years to wait? Do you have another 5 years to wait? Do you have another 3 years to wait? Do you want to wait 3 years? Then get some insurance. Buy some insurance for that $500,000 car you're driving around out there in the stock market. You're driving around without any insurance on your $500,000 car. What if you crash it? What if the market crashes? You think it's more likely the market's going to crash than you're going to crash your Maserati. I bet you'd go drive around. I'm a good driver. I can drive my car. I don't even really care if I have insurance on it. I probably just have liability. Not going to hurt me because I'll just cover the other guy. I'm such a good driver, I don't even drive with anything but liability just to be legal, right? You can do that. Maybe you don't even want liability. We ought to at least have some insurance on here to protect ourselves. That's what I'm talking about. That's what I'm talking about. We're going to buy some insurance, all right? When? Well, we're going to look at the market going through these 3 drive patterns. When it starts, I'm going to make it real simple for you. Yeah, forget about Fibonacci. How many of you watched the last issue of Pitt News Magazine? I know you all did here. Everybody in this class did, because you guys are here. That's why you're here. I'm preaching to the choir, and I realize that. You guys are here, all right? And so I'm teaching. So this is Pitt News Magazine, and you guys all have this article. I know, because you're here. You wouldn't be here if you didn't have this magazine and if you didn't read it already. But you're going to come down. This is the February issue, and we talked about in this version of the magazine, where let me get to the, so this is what I want to talk to you about right here. The seasonal nature of the market. February is what we call the market. This is the give back month. February market realities, the 7 signals hidden in a market seasonality. And we call this the give back month right there. I published it right there in Pitt News Magazine, and this article was written in January. Why? Because we know what's going to happen in February, because past performance is not necessarily indicative of future results, but it's the best we got. And February is always what we consider, we call that the give back month. What are you giving back? Well, you're giving back all the money you made in the last quarter. Okay. You're giving back everything. It's right there. January frequently delivers early year gains as retirement inflows and investors optimize, drive prices higher. But come February, those flows wane and the market begins to recess. It's right there, published in the magazine. So if you didn't have insurance, don't blame me. I published it in the magazine. Told you. High probability February is a bad month. Okay. Now, this one started way back here in January, bad month. Okay. So what are we going to do? We're going to look at this moving average. Oh, that's another article I wanted to show you. Claire and I wrote an article. Let's go to look at Claire's article. You come down here. It's called Decision Point Trading. Decision Point Trading. Can you read? Look at there. There's Claire. There you go. There's a picture of Claire right in front of the Dixie Rock. So there's Claire. And she says, I used to stare at charts all the time. And so I created this little strategy just for her. All right. And for other people that have a hard time with Fibonacci and Elliott wave and 3 drive patterns and all that stuff. I said, just watch the moving averages, because they do kind of the same thing. So this is a great article in Pitt News Magazine that tells you exactly what I'm telling you, when you're going to prepare for the markets to go down, when you're going to prepare for the markets to go up, when you're going to buy in, when you're going to sell out. All right. That's what this is all about. And of course, we go in and we show how we're going to do it with portfolio matrix and how you're going to decide where you're going to put your money into which markets and how you're going to diversify and all that kind of stuff. But this is basically your what I call your decision point trading. All right. So if you come over here to my little book, then you go up to the top. Come on, open up. See? Beyond Fibonacci, decision point trading. It's the book. So she published this article where I taught her decision point trading, and that's where we're going to learn how and when using the moving averages that you're going to start to put yourself, you're going to start protecting yourself. If the market's moving really hard, fast, and it's come up out of the accumulation stage, and it's moving up like this, and it just keeps moving up, and the 100 period moving average is following up like that, you can drive without insurance, because a lot of people will go broke in a hedge fund hedging themselves. So, if you're always buying insurance, you're spending all your money on insurance, you're not making any money. Now, with these high yield funds, one of the great things is they return such a high yield that oftentimes you can hedge the whole time, all the time. Always have a hedge on. Always protect yourself to the downside. And because you're getting such a high return on the yield can pay for the insurance, and you can still have enough yield left over to make money. So we can even dial it in that close. It's really cool. We're going to do more of that as we keep coming to class. Subscribe and come to class. I know I ramble a lot, but I teach a lot too. I got a lot of good stuff to share with you guys. So use the 100 period moving average, and that's when you're going to start to get nervous. When it starts to come down here and testing that 100 period moving average. Now it might come down and bounce off of it a few times like this, but it's when it breaks through like that, you damn well better have some insurance. All right. Because that's when that thing's going to flush like a toilet. If it breaks below the 200 period moving average, you might want double insurance. All right. That's where it's going. Once it breaks down through here, this is where we're going to expect it to go down, and we want to see it roll around. And remember, we call this a Darvas box, right? So one Darvas box. So this is coming to the end of the first Darvas box, or this current Darvas box. And once it comes out of the Darvas box and goes the other side, it's going to go through the accumulation stage again, the reaccumulation down in here. And we expect it to just kind of come down in here, go sideways for a little while. We don't know where it's going to go, jump all over the place. But then it's going to start this whole thing all over again. And it's going to go up, and the 200 and 100 period moving average are going to swing down underneath it, and then it's swing back up. And the market's going to come above that 200, and it's going to come above that 100. And that's down in there. That's where you want to be a buyer. Buy low, sell high. Don't buy way up in here. That's buy high, sell higher. It's hard. Don't do that. Now, if you're going to buy up there, you can do that if you're smart enough to hedge it. Okay, but you got to hedge it. So we have pairs trading. So this is Palantir. Palantir's pair is the PLTY. And you look at that and you're like, why would I be in that market? It's going straight down. Well, it has been going down, but that's because we've been taking the profits out of this market that's been going straight up. That's the pairs trade. We have two trades. We have one that the growth market, which is this one, PLTR, and we have PLTY, which is the take the money out market, the one that takes the money out of the rising market and you make money in it, right? You take it and go spend it. Buy Teslas with it. Go buy food, colos, go on airplane rides. I don't know. Do what you want with your money. That's why this market kind of goes down. It's been going down because the market's been going down here late, the last little bit. That's that little piece right there. You're seeing that the market's going down. So we need to have when the market starts to go down, we need to have ourselves hedged. Now we don't hedge on PLTY. Why? Because there's no options, and we hedge with options. Now there are. You can look at them and see there's some options here. They have them here, but they're not really here. They pretend like they're not here because they're so bad that you can't trade them. See the open interest and the volume? They're all 0-0. Look at the spread. $240 to buy an option that costs you $260. So the premium is $260, but the spread's $240. Why would you ever buy that thing? You don't, right? So we don't buy options on PLTY to protect our position, which is in PLTY. So when we buy, we think, well, Palantir is a good market. It's going to go up, and you want markets that are going to go up, okay? You want to invest in markets that are going to go up because when the markets go down, you don't make money. So you just need to protect yourself if you're going to leave your money out. The best thing to do is just get out. But then I don't get anything. Well, you're not going to get anything anyway. The markets are going down. You're not going to get anything. You're just going to make less. Well, that's not true because markets can go down and you can still make money in some of these funds because you'll get more dividends than the market goes down. But the market can't go down fast. If the market goes down fast, well, the dividends can't outperform the decay of the market. The market's going down too fast. The dividends coming in can't pay for it. So you lose money. You just lose money. You lose less money and you lose it more slowly than the guy that's in the underlying stock. Okay. So if you're in Palantir Direct, don't tell me that you're not losing money. Well, I'm not trading that Yield Max fund. Look at that. That thing lost money. Well, so did the underlying Palantir stock. So what we do is we come in and we protect ourselves on this market, not on Palantir. We don't have any money in this market. Now, it doesn't mean you can't. You certainly can. And we've talked about that strategy too. There's nothing that's definitive. We can put money in here too. And I wrote articles about that in Pit News Magazine about designing your yield. All right. So you can have some in growth, some in yield. You don't need it all in yield. If you don't need money, don't put it in there because they're going to tax it to you. So put it in here. But if the market's going to fall, we got to protect ourselves. How do we do that? Well, if we got a whole bunch of money over here in Palantir and we need to protect it to the downside because this market's starting to flush out, we need to have an option in PLTR, not in PLTY. Again, PLTY, 0 options. See that? They're all dead. We come over here to PLTR. Oh my gosh, lots of options. This is where all the options are. And this is how you protect yourself. You buy a put option. But you need to have enough put options to cover the shares that you've got over in PLTY. That's how you do it. So that's why you need a calculator. So this little calculator, because we're going to be protecting ourselves using PLTR, in this case, PLTR options to protect our PLTY trades, we're going to come in here and we're going to go to our little calculator right here. Not that one, this one. And we're going to say the Yield Max Fund. Now, in this case, it's using Tesla as an example, but we're going to come in here and we're going to go down. We're going to say we're going to use Palantir and we're going to use the Palantir PLTY. So we're going to go over to PLTY and it wants to know the Yield Max Fund price. So PLTY is currently trading at 38.94. So 38.94, put that in here, 38.94. And then we're going to come in here and it's going to say the underlying stock price, okay, in this case is going to be PLTR. And the stock price is currently trading at 137.01. Now we can't protect ourselves from last week's fall because last week's fall is over. So we can only protect ourselves from this week's fall. So 137.08. So it's 137.08. Now it's going to say cost of one underlying put option that we're going to pay for. So we're going to come over here. We're going to go back over here and we're going to do it on PLTR because it's got lots of options. PLTR. That's right. And we're going to come down here and we're going to go out 100 days. Closest to 100 days you can get, 98 days. There it is. And we want it to be dark. All right. We want it to be bright. We want it to be a bright color and we want it to be about 100 days. Closest to 100 days that's dark. Now, if 132 days was dark and there was nothing else closer to 100 days that was dark, we'd take the 132. But if 70 days was closest, we'd take the 7 days. But that's kind of short. We don't really want that one. We want the 98 days. And it's dark, so that's the one we're going to take. Okay, so we got that. We come down here. You can see it's $1,470 for an at-the-money put. Now, we're going to come in here. We're going to put that on the screen. It's a little calculator, right? We can see it right on the screen. How come it didn't go on the screen? There it is. Okay. Took it a second. All right. So I got a slow internet because I got so many things running. Okay. So that's where we're going to put it right there. That's the one we're going to use to protect it. What that's going to do is it's going to make it so that we don't lose any money from there on down on every 100 shares that we have, right? It's going to stop the bleeding. That's what we call a hedge fund. It's hedged. So now if the market comes down for every 100 shares that we have, if it falls below that green line, we don't lose money. Now, it's not going to be perfect because you have because this is the delta 0.41, so it's only going to cover 41 cents as of today. But by the time it gets to that purple line, it will be 100%. It'll cover 100%. So it's going to show this losing money, that you're losing money if it goes down there. But as time goes by, it will make more and more and more money. So this will make as much money as the market is losing for every 100 shares that you have. So now what we got is we got a $1,460 cost to put on our hedge. So we're going to bring that number over here. $1,460, $1,460. We put it in there and it says estimated dividends per share. Now we got to go back over and we got to go over to PLTY. And for this, we got to get and we can do it just by going into portfolio matrix. And you can come in here and you can go down to, let's see, we have to pull up PL. I got this set where I want it here. I'm going to go do it over here. So there's multiple places you can get your PLTY. So you can get your Normally, I just get out of portfolio matrix, but we can get it right here too. So we're going to come here and we're going to look. It's 35.359. That's the number you want right there. See that? 0.359. 0.359. Now, you can look back the last 3 and kind of average the last 4 or 5 to see what it is for a month. See, this one's 0.41. This one's 0.37. This is 0.36, but the market's falling, so it gets lower and smaller and smaller. We're just going to go off the smallest one. Worst case scenario, 359. So we're going to come back over to our calculator. Oh, it's on the right one. Okay, calculator, 0.359. Go to the calculator. We're going to type that in here, 0.359. Then we're going to come here at the trade duration is going to be, how long was our option for? Our option was for 98 days. Okay, so we're going to put 98 days in here, 98 days. And then how often does it pay us our dividends? Every week, weekly. And we hit calculate the hedge. Now, so what this is telling us is that the fund shares, we're going to buy 353 shares is what it's going to cover. Total capital is $15,000. So for this hedge, it will be a perfect hedge if we have for every $15,000 we have in Palantir or PLTY, this option is going to protect it because it's being bought over on PLTY at a much higher share price than what the share prices are on PLTY. PLTR is much more expensive, but that's where the options are. You can't go trade the options over on PLTY because they're not worth it. So the whole idea is that you're going to do it here. And see, it says right there, it's a profitable hedge. So the total cost, the shares plus the hedge, is $15,000. Total gross income is going to be $1,774, less the insurance cost, $1,460. Net profit after the hedge is $314. The actual return is 0.2% or annualized return of 7%. So you could do that on here. All right. That would be hedged. And not only would you be what we call delta neutral, you wouldn't lose any money if the market continues to fall on your $15,000 that you got in PLTY, you'd actually make 7%. You'd make 7% annualized return in a market that's flushing down like a toilet. And everybody else is jumping out of windows and you're making 7% annualized return. Land Turner's showing you not what you should do. I'm showing you what I do. If you don't want to do it, I can't make you. I'm just showing you what I do. That's what I do. All right, guys, go get your Pit News magazine. If you don't have it, subscribe to the channel, come back, and we'll do some more of this. You just got to be exposed to it. I know you can't learn it all in one day. Start small. Start small. Okay, and we'll do it. We'll do it. Okay, that's all I got for you. Does anybody have any questions quick before I let you go? Doesn't look like it. I kind of cussed everybody out good at the beginning, and hopefully some of you still stuck around, but learned some good stuff. Why do they call them hedge funds? That's how a hedge fund does it. All right, so they can be profitable in a down market because they go delta neutral. John says, why do you hedge on the QQQ and not on the underlying? Because I have on the QQQ, I have YQQQ, and I don't have in the yield max arena of funds, I don't have a short play for the Qs, but they do have a short play for the Qs. They do have a fund that you can buy that makes money when the market goes down. That's why I did the Qs, because the Qs, they have QQQ, that's for markets when markets go up, and YQQQ, that's for when markets go down. So rather than buying options and paying those premiums, I just bought the YQQ. So if the market goes down, I make money. And it was a small, I mean, because the probabilities were so low that the market was going to go up, it was almost a no loss. I mean, it was a very small. I mean, the markets could turn and go back up, but they're not. I mean, I was right to do it. But see, I got in with this one, right? Here's why I got in on that one. That's a good question. Uh-oh, what did I just do? That's a really good question, John. Because the reason I'm using options on Palantir is because I don't have a short on Yield max does not give me a short, opposing short for the Qs for Palantir, but they do for the Qs. They also do for like several others. So if we go over to their website, let's go over to their website quick. That's a really good question that we should probably answer before we shut down for the day. Where did their website go? Right here. So if we go over here and you go into our ETFs, you'll see that they have short ones right here. Short single stock options income ETFs. So Crash, CRSH, that's for Tesla. So if you want to hedge your Tesla, you don't have to buy options on Tesla unless you want to. You can do it that way, and I have. I've bought the options on Tesla. So I've got options on Tesla protect me to the downside. So I'm actually making a couple percentages, and I could show you, but I'm making a couple of percent returns on my Tesla because I got options. If I wanted to, I could use CRSH, and I did for a little while. I had CRSH because CRSH is the opposing side to Tesla. So if Tesla goes up, you're in TSLY. If you think Tesla's going to go down, you're going to put it in Crash. Now you can do a little bit of both, right? You can say, well, I'm not sure. So as it goes up through the trend and it gets higher and higher and higher, you're going to roll out of TSLY and into CRSH. So it's going to be a smooth and natural transition so that when you get up at the top, you're more into Crash than you are into Tesla long. That way, when it starts to come down, you got money making this way and you're not losing as much money this way. And as it comes down, you can roll back. Now, again, I'm going to go back over to, before I go back over, but then you have dips. This is one, Fiat, Winter, and YQQ. Those are the only 4 markets that are covered with short side yield max funds. So you can use those. Otherwise, you're going to have to use options. Okay, so those are the only 4. So if we come back over to the stock market, and I'm going to now, I was going to show you, I was going to show you Pit News Magazine. In Pit News Magazine, there's another article in this issue. I think it's in this issue. It might have been in the last issue. Let's look and see. Yes, right here in the same issue, February issue. So you got three very important articles in the February issue. You got decision point trading, which is going to tell you about when to execute these, help you simplify the process of executing your hedges. You got high yields explained, which is yield max isn't a stock, it's an insurance company. So we talk about that one. But then we got Misty versus Winter. And this one is one where we talk about the opposing side. So this is exactly what John asked about. It's like, when do you use this one? When do you use that one? And we go through and we explain this whole thing about, we were holding Misty, right? And Misty was really bad. And so Misty lost us a bunch of money. But these guys actually gave us Winter. So we had a tool available to us, which was this one right here, WNTR, which is the short side to Bitcoin, basically, because that's what Misty is. Misty is basically Bitcoin. So we could have been hedging ourselves to the downside, but we weren't. We were just letting the option or the premiums pay for the slide down, and it was doing it okay, just fine for a while. But then it went really fast and it outperformed it and it couldn't. But if we had Winter, we could have protected ourselves to the downside by rolling into Winter and making money on the downside. That's our hedge. So there's 4 of them here: Crash, Dips, Fiat, Winter, and YQQ. Crash is Tesla, Dips, I can't remember which one it opposes. And NVIDIA. Okay, so NVIDIA. So if you want short side on NVIDIA, you don't have to buy options. You can just come in here and buy dips. What's the other one? Fiat. That one's the currency, Coinbase. So Coinbase, the short side to coin is the long side. Fiat is the short side. So you can use this strategy that we highlight over here in Pit News Magazine on this article right here on how you use these two to roll back and forth into them so you don't have to buy options. So that's a nice way to do it, so you don't have to buy options. Now, I'm really familiar with options, so I like to buy the options anyway. So in Tesla, even though I have Crash, I bought the options. Doesn't mean you can't. You can do both. Which is better, Lan? I think the options are better because of the math that I just showed you, because I can actually make a profit, 2%, over the 100 period, or 7% annualized return. I can still make a profit. Now, it doesn't mean you can't make a profit using crash too. You can if you manage it properly. If you're all into crash, you move it all in, move it all out. This way, I'm hedging. I don't know if there's a better or worse. It's just different. All right. It's just different. And it depends on how you manage it, whether you're going to make more money or less. I don't know. But either way is better than doing nothing. Right. It's better than doing nothing. And you don't buy more. Like, let's say you have $10,000. Let's come back over here real quick. Let's say that you have $10,000 in TSLY, and then you think the market's really high and it's going to go down. You don't buy crash. You don't go in and put $5,000 into crash. So now you have $15,000 of exposure to Tesla, 5,000 short and 10,000 long. What you do is you roll out of Tesla, so TSLY, and you roll it into crash. So if you have $10,000 in TSLY and you want to put 1,000 of it, or 2,000, or 2,500 of it into crash to protect yourself to the downside, you take it out of Tesla and put it into crash. Now the problem with that is, remember, if you sell it and it's profitable, you're going to have a taxable event, which is why it's nice to do it in some sort of IRA. You don't have a taxable event. But if you do it out you're going to sell some of your Tesla and it's going to have a taxable event. That's why I use options, because you can avoid the taxable event. You can hang on to your stock, buy the option, and then the insurance premium is there and it protects you against the downside slide. And you don't have to sell your shares, so you don't have to have a taxable event. So it depends. Maybe if you're in a fund where you're in an IRA, you'd use these probably more prevalent than you might an option, because you're not going to have a taxable event anyway. But you're going to roll out of Tesla and into crash. So you're going to keep your same 10,000, but you're just going to move it as the market goes higher and higher and higher. You're going to start to roll it over into the other ones. Now, are you going to, at the end of the year, I'm not going to make my 80% annualized return if I do that, land, because I'm going to be hedged all the time. Yeah, you're going to probably only make 20, 30, 40% annualized return instead of 80%. But you're protected to the downside. You're not going to lose a whole bunch. You're not going to suddenly lose your entire nest egg. Your golden goose isn't going to just get, right? All right. So hedge, that's why they call it a hedge fund. And if you're going to come to my class, that's what I tell you all the time. We're here to run our own little hedge fund. And so if you're going to run a little hedge fund, you have to run your hedge fund. You can't just come and be a buy and hold guy. This is not, hedge funds don't buy and hold. You want to learn a lesson? Here's what we'll end with. I know I've gone way over time. Kathy Woods. She owns OARK. Kathy Woods. I want you to go and do a little research on her. And the reason I like Kathy Woods is because she's transparent. She's as transparent as I am. All right. ARK Investing. ARK-funds.com. I want you to go and do a little research on Kathy Woods. She's the fund manager for a hedge fund called ARK Funds. Now, I'm going to tell you something that's really cool. In fact, I bet you if I pull up my email, she is going to I'm going to check my email here, and it's going to accept all her cookies. Okay. And I agree. I'm going to agree to this. So this is ARK Funds. All right. And she funds, and we can actually trade her funds with the Yield Max funds. OARK is actually her, ARKK. All right. So one of her funds is called ARKK. That's her primary fund right there. So if you come over here, and we'll just go pull it up in Track and Trade. We're going to come over here, and we're going to go to ARKK. This is ARKK. This is her. There it is. What? Oh my gosh, land. She's a hedge fund. Look at that picture. Picture perfect hedge fund, just like the Richard Wyckoff accumulation distribution model, like a train on rails. Okay, but that's her fund, ARKK. So if you go over to her website, you can see all of her funds. She got a whole bunch of them in here, but the one that's the biggest one is ARKK, and that's what in Yield Max they'll trade it for you. OARK, right? OARK. That's the Kathy Woods Yield Fund. They're pulling the yield out of her fund. Now, the reason I say that, and I went over and got my emails, and if I go down through my emails, I'm going to bet you $100. There it is. You owe me $100. Look, I'm on her email list. She sends me every trade she makes. There's ARKK. She bought. She sold. See, are in giant hedge funds don't just buy and hold. They don't buy and hold. Look at this. Here's her ARKQ. Buy, 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 sell, sell. ARKW. Buy, 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 sell, 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 sell. ARKG. Buy, sell. ARKF. Buy, sell, sell, sell. ARG. Buy, sell. She tells you every single thing she's buying and selling. Now, I wouldn't recommend you come in here and say, well, it's Kathy Woods. I'm going to come in there and I'm going to do what she does. Right? I'm going to go in there and I'm going to do everything she does. No, you probably don't want to do that. If you're going to do that, just buy her fund because she's doing that. All right. So that's what this is. They're trading options against her fund, but her fund is ARKK. That's this one here. All right. That's it. So the reason I show you that is because you can go over to her website. You can sign up and she'll send you that email. And she'll show you everything she's buying and selling in every fund. She's very transparent. I don't know any other hedge fund that'll do that except for me, and it's just my own little personal hedge fund. And I don't even do it I don't do it that transparent. I don't send you an email every time I buy and sell. I just show you here on YouTube what I bought and sold, what my portfolio has in it. But there you go. There's some more information for you. So just to give you an example, hedge funds buy and sell. They don't just buy and hold. If you want to buy and hold, just go trade an index. Just go buy QQQ. Just go buy that. Buy and hold. 40 years. Happy, happy, happy. All done. Don't have to do anything else. I've taught a lot of people to do that. Guys that have no acumen for trading. I just tell them, just go buy this because they're going to do all the hard work for you. Just hold it 10 years, 15 years, and you'll have money. You'll have some money probably, most likely. Past performance is never indicative of future results. We have no idea what's going to happen in the future, but it's the best information we've got. And that is why I decided to take my short position right there. This is the triangle wedge formation I showed you in the previous class. The market went up, drive 1, drive 2, drive 3, drive 4, right? Fourth standard deviation. Started to make that. It did this little thing right here where it went up, tested it, went up, tested it, went up, tested it, and I said it's going to fail. And that's why I went short. It's just probabilities. I didn't, this little guy, I asked him, but he doesn't really talk a lot. So I stab him with pins to make him do what I want. And sometimes it works really good. He's powerful. Right? I got one that's even more powerful than that. Look at this guy. This is if I really have to get serious. This guy, ooh, nasty. All right, that's how I make the markets move, and I just do it with the delta cone of probability. It's all based on these mathematical models down here in the options table. All right, guys, we wore ourselves out today. I'm going to let you go, and we're going to meet up again next week. Class starts on Monday down at the university. If you're in the local location or you want to come and stay in an Airbnb, come and take the class. It's going to be a fantastic class next week, and we're going to talk all about all this stuff again. We're going to teach it down at the university, and we're going to do it in class here. So come back and join. Make sure you subscribe. Make sure you go get your Pitt News magazine, and make sure you read it. All right. We'll see you guys later.
All right. That wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News magazine.
Oh, yeah. Definitely subscribe to Pitt News magazine. You'll thank us later.